Okay, we've talked a little bit about the three questions that financial managers face. So let's talk a little bit about a financial manager. Now, if we look at the three main concerns of a financial manager, the three main areas that's handled by financial management, these could all be wrapped up into the same person. So the same person could be doing strategy, coordination, they could be the authority, the decision maker. They could also do cash flows, capital expenditures, capital structure, and of course they can do the accounting, information system, taxes, audit, and so on. So they could all be wrapped up into the same person, but often they're not. They're usually wrapped up in larger companies into multiple either divisions or departments, and they all eventually do come to the head at a position that most people call a CFO, or Chief Financial Officer, usually reporting to the CEO. So let's look at that structure in a large organization. A large organization, of course, the board is representing the shareholders. They have a CEO or a president. They might have a chief operating officer as well, president or chief operating officer, depends on the structure of the company. Underneath that, they will have a vice president or sometimes a chief financial officer, depending on the company, or it could be both. They will usually break the roles into two if they have multiple people underneath them. One is the treasurer. They deal with cash, credit, capital expenditures, paying the bills, things like that, financial planning. The controller is more of the detail-oriented, the tax manager, the financial accounting, data processing, cost accounting. The controller is knee-deep in the weeds, as it were. They're not really doing planning as much as they're magnifying or making sure that everyone knows what exactly is going on financially. Now, these roles are obviously going to be different for every company. So the corporate firm, the first thing they have to worry about, regardless of the company, is to raise funds. How are they going to raise funds, and what form of business they are is going to have a great deal of impact on how they raise funds. Now, clearly, the larger you get, the more you tend to be a corporation because you want to raise funds from outsiders. But I encourage all of you to think about starting your own business one day, and if you do, you're probably not going to start as a corporation. You're going to start as a sole proprietorship or maybe a partnership. So let's look at these three different types of organizations. There's sole proprietorships, there's partnerships, which is a general partnership or a limited partnership, and then of course there's the corporation. So a sole proprietorship means you're starting business on your own. Partnership means you've got multiple people involved that have different ownership stakes. General partnership would be everybody's in for maybe a different stake, but everybody's in. A limited partnership would mean that there's a general partner that worries about the liability, but a limited partner is I've invested, but I'm not liable. Those are two different types of partnerships. And of course, the third, of course, is a corporation. So let's look at a comparison here. Between corporations and partnerships. Liquidity, corporation, you can easily exchange your shares. Partnership, somewhat difficult. You've got to sell to somebody that the partnership wants, or you have to sell it back to the partnership. In a corporation, each share gets one vote. In a partnership, usually the general partner is in charge. Limited partners may not have voting rights or even any rights at all, depending on the partnership. Taxation in a corporation is double taxation. So the rule on a corporation, they do have separate types of corporations. So a C corp or a general corporation will be taxed to the shareholders as paid in dividends, and of course the pay of the employees is taxed. But if the company retains profits, those are also taxed. So you have to realize that you're going to pay double taxation if you are a sole owner of a C corporation. Now they have S corporations and LLCs, or limited liability corporations, which allow the pass-through of the income to the owner and still maintain the corporation or the corporate veil of liability. But regardless of which, and that shields you from or avoids the double taxation. So major corporations, Apple, Microsoft, Coca-Cola, are taxed twice. The shareholders get to pay their tax even though they're an owner, and of course the corporation pays its own tax. So there's two taxation levels there. If you're a partnership or a sole proprietorship, all the money flows every year to your own personal taxes. So you have to pay taxes on the profits every year. Beyond that, there's reinvestment and dividend payouts. There's broad latitude in a corporation. And of course, in a partnership, all net cash flow is distributed to the partnerships every year. The liability corporation, limited liability is for the corporation. General partners may have unlimited liability, but limited liability partners can enjoy, and as it says here, limited liability. And of course, continuity is corporations last forever. They're continuous. They're set up so the people can change, but the organization still goes on. Obviously, corporations like Coca-Cola and General Electric have been around for a long time. The people change, but the entity still exists. And of course, a partnership is limited to the partners that are involved, and they can sell to other partners. But if all the partners die, the partnership gets dissolved. So we've seen a couple. I've got a couple slides here. One is global consumer brands. You can see how many corporations own other corporations. This slide shows you Kraft, Coca-Cola, Nestle, Procter & Gamble, Kellogg's, General Mills, Johnson & Johnson, Unilever, etc. all own multiple brands underneath them. So you can see that there is a multi-level corporations or conglomerates out there that own other companies. So you can go quite deep into owning other companies. The second thing is the mergers. This is a consolidation slide that talks about just media and shows the media consolidation of the companies into a few hands. General Electric and News Corp, Disney, Viacom, Time Warner, and CBS have pretty much cornered the media markets, or the major media markets. And as you see that, one corporation can own multiple other corporations. So they would own other corporations to brand them separately. Obviously, they're going to brand their paper towels different than their toothpaste. They're not both going to be, General Mills toothpaste. It's going to be branded separately. Same thing with cars. We have Toyota, we have Toyota cars, but we also have Lexus, and those are two different brands. Honda and Infiniti, they're Cadillac and General Motors and so on. So you know that they brand the different companies separately. But in consolidation, if you think about it as consolidation, they're still working together as a company. So we want to acknowledge that as a corporation and take that into banking. As you can see in this slide in banking, that the banks have all merged pretty much together. A lot of the major banks have merged together. So we have Wells Fargo and BofA and so on are all a conglomerate of a bunch of smaller banks. So you can see that in banking it's come together, in media it's come together, in other things it's come together as well, to where there is one head of many corporations. So when we think of corporate form, we don't want to just think of it as a corporation. It's corporations that hold other corporations. So there's a lot of depth to that. We'll get more into corporations owning other corporations and the pluses and the minuses of that in just a few seconds as we move on to the next video.